So good morning, good afternoon, and good evening, depending on where you are on the globe. And welcome to this new edition of the webinar series hosted by the e-Access Forum and the European Banking Institute. Today, you will learn more about how to assess climate risk and integrate this risk into prudential regulatory capital. I think it's a topic which is as crucial as ever, as we have seen climate risk for financial stability continuously rising for the last 10 years. And to discuss that, it's our pleasure to welcome two great experts on prudential regulation and climate risk, Kevin Stiroh and David Ramos Muñoz. Kevin will start by presenting his work on climate change and the role of regulatory capital. And then David will give his remark on this topic from more legal point of view. And after that, we will have plenty of time to discuss and answer your question. So if you have questions, please post them in the Q&A section. And after the talks, I will relay them to Kevin and David. Before jumping in the presentation, let me quote one of our guests. A shock is a shock, and anything that can impact the real economy and the financial sector should be understood and should be part of risk monitoring and assessment process. I would add personally that it should also be part of prudential regulation. Micro and macro prudential policy should make sure that the financial system is resilient to shock, including climate shock. And I think it should also aim to mitigate the buildup of climate risk if possible. Well, that's my opinion. I'm sure that it can be discussed and be more nuanced. And unfortunately, we have two excellent guests to discuss that, who I guess have also strong opinion about this question. And I'm looking forward to hearing them. So let's start with Kevin Stiroh. We are very lucky to have Kevin with us. He has been at the center of the reflection by financial supervisors worldwide on this question. Kevin has more than 30 years of experience in banking supervision and financial market analysis. He is the director of the Climate-Related Financial and Macroeconomic Risk Initiative, which is a research collaboration between Harvard University and Resource for the Future. And until recently, he was a senior advisor in the Supervision and Regulation Department at the Board of Governors of the Federal Reserve System. He was also co-chair of the Basel Committee on Banking Supervision Task Force on Climate-Related Financial Risk, which is the body that developed international guidelines on how to address climate risk in financial institutions. And today, that's just the last two of his role. I will not go through the whole list. And today, Kevin will present his paper, Climate Change and the Role of Regulatory Capital, a stylized framework for policy assessment. And I think this paper has contributed to shaping the views of financial supervisors on climate risk and capital regulation. So I'm looking forward to hear him. After that, we will pass the screen to David, which I will properly introduce later. Kevin, the screen is yours.
Great. Thanks, Pierre. And thanks very much for the invitation to participate in the forum today. As Pierre mentioned, this is a recent paper that was published in the Journal of Financial Regulation with my co-authors, Michael Holscher, David Ignell, and Morgan Lewis. And I want to emphasize that everything I say today is my own views on the topic and not necessarily those of my co-authors. So on the next slide, please. Great, thank you. Really, the goal of this paper was to try to develop a very objective framework to help think about the link between the financial risks of climate change and regulatory capital. We wanted to be as objective as possible and lay out a clear relationship between the two, and in particular, to identify what assumptions one needs to make to draw a link between the financial risks of climate change and regulatory capital. We also wanted to highlight areas for research. The two main conclusions for policymakers are that you need very specific beliefs about how climate change might be affecting the future potential losses of banks. And in particular, we draw a distinction between expected and unexpected losses. And I'll go into more detail on that in a moment. This is a topic that is familiar to those who are deep in the weeds on bank capital, but I'll explain a little bit more about what I mean by that. And then second, the regulatory capital regime is really complex. There are many objectives and many components. So it's important to be clear about what problem you're trying to solve in order to think about what is the right place where regulatory capital might be the appropriate solution. The paper is conceptual, and the real world is obviously much more complicated. The paper goes through a lot of examples of some of those complexities, and I'll just talk about 4 of them today around uncertainty, time-varying risks, how you rank relative risks, and the case where there are multiple mandates for supervisory authorities. So on the next slide, just to make sure everyone is on a level playing field, if you turn to slide 3, please. Thank you. I'll give a very high-level overview of what we mean by bank capital and why that's relevant for prudential supervisors. So bank capital is the investment by owners of a bank that absorbs losses and it protects depositors and debt holders. It's widely viewed as a signal of bank health, but also viewed as expensive for banks. So they try to minimize the amount of capital that they hold. And to understand why it's important, on the right is a toy balance sheet for a bank where you have assets such as loans, securities, and cash on the left-hand side of the balance sheet, and liabilities like deposits and debt on the right-hand side. And then capital is the difference between assets and liabilities, the investment of owners. And why that's important is if there is a shock that causes the assets to lose value, for example, if mortgages default because of floods that occur, then the value of those assets declines and capital can absorb the losses. And if there's sufficient capital, it can absorb the losses and allow depositors and debt holders to be repaid. Bank regulators recognize this and put in multiple regulatory capital requirements that say how much capital needs to be held by a given bank. The capital requirements are really complicated, much more so than I'll explain here. The full Basel framework has over 1,000 pages describing the regulatory capital framework. But 2 ways that regulators would think about capital are a simple leverage ratio. That's effectively the ratio of capital to total assets. And then second, a risk-based capital ratio, which would be the ratio of capital to assets on the balance sheet, but weighted by their relative riskiness. So you would put a higher weight and have a higher capital requirement on an asset like a mortgage relative to an asset like cash on the balance sheet, because there's greater risk of loss to the bank. So on the next slide, we can think about 2 different ways to potentially view bank capital. What I just described was a very traditional view focused on the resilience of a bank. Capital is there to support bank operations, to absorb losses, and to protect depositors and debt holders, both for the bank's health and the health of the financial system. And this is embedded in prudential frameworks around the world. In the paper, we give some examples around the Basel Committee framework that sets standards for internationally active banks, and then how that is implemented by the Bank of England. The European Banking Authority talks about this, and the Federal Reserve Board. On the other hand, there's an alternative view about the role of capital, which is more about incentives. And if you view capital to be relatively expensive, then by changing the amount of capital that is required, you can change the marginal cost of certain assets and give incentives for bank balance sheet shifts. For example, this is the case for a capital supporting factor for small and medium-sized enterprises in Europe. In the context of climate change and the transition to a low carbon economy, some have argued that you should have green supporting factors that effectively subsidize or lower the risk weights for certain low carbon activities, or brown penalizing factors that apply higher risk weights as a disincentive for activities that contribute to greenhouse gas emissions. And there are a number of proposals from academics, from advocacy groups, and some central banks. And in some cases, this links back to the mandates that central banks have, which is an important issue that I'll come back to in a few minutes. So on the next slide, please. There is a large academic literature that I'm not going to cover here, but we detail in the paper with different views about whether or not this incentive approach is appropriate. I'll just emphasize one point, a really nice paper by Anjan Thakur in 2021 that makes the point that any credit allocation that comes from using the regulatory capital regime necessarily leads to higher fragility and then should be offset by higher capital ratios to account for that greater fragility. On the next slide, we talk a little bit about how do we actually set capital requirements. So this would be, again, a stylistic way, a simplified representation of how one would think about how regulators set the required amount of capital. And you can look back historically, say in the top panel on a time series of bank losses. That's just an indicative. A couple slides back, please. Yep, perfect, thank you. An indicative time series of losses, and you can calculate what's the expected loss over time. That would just be the mean of this time series. And then in any given year, you might have unexpected losses, which are incurred losses above and beyond the mean. And expected losses are just that, they're expected. They're the normal cost of doing business, and you can account for those through traditional risk-based pricing or loan loss reserves. Unexpected losses, when losses are higher than you might typically forecast due to a recession or some other shock, you need capital to absorb those losses so that the bank can continue to operate and provide the critical financial services under a wide range of conditions. And then the bottom chart translates that time series into a frequency distribution, a probability distribution of losses. And the way capital can be set would be through a value at risk approach, which looks at that full distribution of historical losses, calculates the mean, and that would be the amount of expected losses that would be covered by risk-based pricing or loan loss reserves. And then you would set capital to cover unexpected losses with some confidence level. In this chart, that's called the VAR threshold. And the idea is with a certain confidence, maybe 99% of the time, losses would be to the left of that VAR threshold, and you would have sufficient capital to continue to operate. 1% of the time, you would have even higher losses, and that's the part of the uninsured distribution. It's much more complex in the actual capital regulations, different thresholds for different types of assets, different look back periods, value at risk approaches versus expected shortfall approaches. But that's the basic idea, that you want to separate expected and unexpected losses. On the next slide, we talk a little bit about the components of the capital framework. Again, this is very complex, and this is just a simple representation. But the idea is that the regulatory capital regime includes a combination of minimums and buffers, each designed to solve a different problem. So for example, the minimum amount of capital that every firm is required to hold would depend on that loss distribution that I talked about on the prior slide. In addition, there are different buffers to solve different problems. Just as one example, the idea of a counter-cyclical buffer, the argument is when you think losses are going to be particularly high, you might be at a certain point of the macro business cycle or the credit cycle, you might encourage banks or require banks to hold more capital, or you might encourage banks to hold capital as those losses are being built up as a way to minimize the increase of potential losses. And each of those can solve a different problem. So on the next slide, please. How does all this have to do with climate change? So the idea is to think about different ways that the financial or economic impacts of climate change can impact those components of the regulatory capital regime. And in our paper, we break that out into two steps. The first step is around the loss generating process. What is that distribution? What is that time series of potential losses likely to look like in the future? Will the physical risks and the transition risks associated with climate change that time series? Will it change that distribution of potential losses? And if so, how? Will it primarily impact the average, the mean losses, the expected losses, or will it be more relevant for the unexpected losses, the variance of that distribution? So that's one question that we talk about. The second one is about the specific objectives that policymakers might have, and where do they show up as a component of the regulatory capital framework. And as I briefly discussed, there are many different objectives that policymakers might have around resilience of individual banks, around macroprudential objectives, around cyclical dynamics, or even around the incentives approach. And being clear about what objectives policymakers are considering is an important part of the link between climate change and regulatory capital. So on the next slide, please. Thinking about step one, the question is, do the physical and transition risks of climate change the distribution of bank losses? And conceptually, if you had an increase in the average loss over time, you knew that that distribution was going to lead to higher average losses. You could price those ex ante through risk-based pricing. You could increase your loan loss reserves as a normal part of your banking business. That isn't necessarily a capital story. On the other hand, if the variance, the unexpected portion of losses were to increase, and that distribution changes, the tail of that distribution becomes fatter, then you might think about how does higher capital help solve those problems? And what would be the explanations? Why would we think that climate-related risks could increase unexpected losses? This is ultimately going to be an empirical question, but there are a lot of stories, a lot of explanations that people are studying now and are in the literature that I mentioned earlier. So as some example, there's just fundamental uncertainty about how the climate will evolve and what the ultimate impact will be through various transmission mechanisms on the economy. Policy changes, technological changes are both unpredictable in ways that might make the impact on banks in the future be more uncertain. We know that there are financial amplifiers and feedback loops that could cause risks and losses to become larger. There's the potential for compound risks, where different shocks happen either sequentially or at the same time that might lead to higher unexpected losses. There are tipping points, both climate tipping points and economic tipping points. And just the simple mechanics of uncorrelated shocks could lead to higher unexpected losses. And the literature is rapidly growing to try to quantify and understand what these different channels might be. A complication is that these shocks aren't the only thing that's happening. At the same time, banks are actively managing these risks. So they're taking steps to mitigate the impact of those shocks, to lower the potential impact on their P&L and their balance sheet. They're introducing new products, they're pricing, they're setting limits. In some cases, they're making strategic shifts to deal with the changes in physical and transition risks. At the same time, the economy will adapt. You'll have mitigants like insurance and government support, changes in the location or the type of economic activity, steps to transfer risk out of the banking system to other parts of the economy. And all of these things can also impact the potential distribution of bank losses. On the next slide, we just give a few indicative illustrative cases of the changes that I described. So case one would be a situation where the average losses increase over time and the distribution keeps its shape and shifts to the right. An alternative would be a case where the mean stays the same. So you don't necessarily need to change reserves or risk-based pricing, but the distribution becomes wider, and that would lead to higher unexpected losses and potentially a change in required capital. And then the third case would be a combination of those. So as a policymaker, you would need to have a view on which of these distributional shifts you're expecting in order to make a change to the regulatory capital regime. On the next slide, please. Well, I'll return to the different components of the regulatory capital framework, minimums and buffers, and how risk-weighted assets are calculated. And I won't walk through all of these just in the interest of time. But we can take one example, say the countercyclical capital buffer that I mentioned before, which is designed to have increased loss absorption capacity in times of elevated macro risks or different points in the credit or macro cycle. And if you believe that things like stranded assets or transition-focused firms or compound risks might lead to higher losses at certain points in time, then you might conclude that it would be appropriate to put in a countercyclical capital buffer to address those issues. And again, there's a lot of literature. Pierre has worked quite a bit on some of these topics from a macro prudential perspective, for example. But for a policymaker, again, you would need to be clear and have clarity about which one of these channels, which one of these assumptions you're making, and that will lead you to where to look within the regulatory capital framework for the specific problem that you're trying to solve. On the next slide, so the last slide, conceptually, I think there is a potential role for climate change to impact the regulatory capital regime, but that's dependent on two specific sets of assumptions. On the one hand, you need to be very clear about what is your belief about how climate risk drivers might impact the loss generating process for banks. And then second, you would need to be very clear about which transmission channel and which objective that is being impacted, so you know where to look in the regulatory capital regime. So that's all from a modeling, a conceptual perspective. As I said in the beginning, the real world is much more complicated. And briefly, I'll talk about 4 examples. So it's easy for me to draw different distributions and say if the distribution is going to shift this way or that way. But of course, in the real world, we don't know that. We don't know if this distribution of potential losses is shifting or how, or when we would have sufficient conviction to know that. In the famous Green Swan paper from several authors at the BIS, they talk about this being the fundamental challenge, and it requires what they called an epistemological break, that you can't look at history to understand how those loss distributions might change. So there's an open question about how would a policymaker have sufficient confidence to make that decision. Scenario analysis could likely help. Many large central banks, many large commercial banks are employing this tool. Another challenge is that these risks are likely to vary over time. Will they be particularly high if there's a period of active policy transition, in a period before there's sufficient adaptation, for example? Policymakers would need to have a view on those about when a countercyclical buffer, for example, might be appropriate to turn on and when it might be appropriate to turn off. A third challenge is that banks, as we know, face many emerging risks. Climate change isn't the only risk driver that they have to deal with. They're thinking about cyber threats or fintech competition or geopolitics or any number of risk drivers. So a question would be, why would this be the area that policymakers would change a general risk framework for, as opposed to any other risk? What is the relative materiality that would drive this to be the right place to start? And then the final point is that everything I've talked about was from this very traditional risk management perspective, where capital is there to absorb unexpected losses. But some central banks and some supervisory authorities have broader mandates, particularly mandates to support as a secondary goal the broader objectives of the elected officials of the federal government. In that world, what is the appropriate way to think about capital? And here I'll come back to the question of, if you introduce additional objectives into the capital regime, what does that ultimately do to the link between risk and bank capital, which is the primary reason why we have capital regulation in the first place? Does that sever the link or make it less transparent? Would bank capital then be a relatively less effective tool for investors to understand the health of the bank? These are all important questions. They're all open issues, and hopefully we can discuss these in more detail, and research will continue on these topics. So thanks very much for your attention, and Pierre, back to you.
Thank you very much, Kevin, for this very clear and concise presentation. As I said, I think it's a framework that a lot of financial regulators and supervisors have in mind when they think about capital. I also guess that most of the question will focus on the issue and question you highlighted at the end of the presentation. Now, let me turn to David Ramos Muñoz for his comment and his view from a more legal point of view. But before that, let me introduce him properly. David is a professor of commercial law at the Universidad Carlos III of Madrid, where he directs several research projects on finance and climate change, and he co-founded the Climate Strategic Initiative of the university. He is also a fellow member and person of the academic board of the European Banking Institute, where he leads its working group on finance, climate change, and sustainability. And David is an expert on the role of court and judicial review in financial regulation, and he's advising several international institutions on these issues. And he has published his research in several top academic journals in law. So maybe after the supervisors and the economist perspective, a more legal perspective from you, David.
Thank you very much, Pierre, for the nice introduction, and thanks very much to Anastasia, Yaxis, and the EBI for the invitation. So I listened very attentively to Kevin's excellent presentation, and it was great that we decided on this order, because there's a lot of aspects that I can simply skip, because I can focus more on a legal perspective. And usually on these aspects, it is common to forget about the legal perspective, and I understand, because one has to get the methodology right. But once the methodology has been decided, there are additional questions that need to be asked. If Kevin asked the question, what is the policy approach that best captures how climate change alters the loss-generating process? A lawyer or someone with an institutional background would ask, how confident can I mean the authority, be in embedding this approach in a concrete legal act, which can be a law, a regulation, or a specific supervisory decision? And what approach can better withstand a court challenge? Because the premise of my analysis is that whatever approach is decided by a specific regulatory authority or legislator, we can be almost certain that this approach will end up in court if the past offers any guidance. So from this perspective, what we would ask ourselves is, what is the act that we would need to change in order to implement this methodology? What is it that I would need to prove, the authority, would need to prove in order to change the legal act? And how would the courts review these acts? So these questions shape the incentives of legislators, regulators, supervisors, and also banks. And when we look at these, we see that there are differences in the types of legal acts that translate Basel capital requirements. So there may be legislative acts. For example, in the EU, most of the Pillar 1 measures are included in the CRR, which is a legislative act. This means that the act is going to be more rigid. It is going to be subject to the political process, but in exchange, it is going to be legally legitimate. So it's more capable to withstand a legal challenge. Then we may have regulatory acts. In the case of the US, most capital requirements are included in regulations adopted by the Fed, because the Fed has a broad safety and soundness mandate that enables it to adopt these capital requirements via regulation. We also have examples in the EU, like the Commission delegated regulations, for instance, on Pillar 3 ESG disclosures, as well as on the acts that the EBA provides for, where it provides advice for pillars 1, 2, or 3. So here, these acts have, you could say, medium flexibility, so that they are easier to change than a piece of legislation, but they raise more legitimacy questions. For example, whether they were adopted by an adequate mandate, whether their delegation was correctly exercised. And finally, we have the supervisory acts, and that's mostly the case for Pillar 2 acts, like the SREP, the actions under the SREP by the ECB, for instance, or the supervisory capital requirements by the Fed. These are the most flexible, so they can be more easily implemented directly by the supervisory institution, but they may raise both legitimacy and execution questions, whether the mandate and delegation were correctly exercised, but whether the powers and tools were correctly and proportionately exercised, for instance. The second question that we need to ask ourselves is about the burden of proof, because in the Basel framework, as it has been transposed into different legal systems, there are, in many cases, certain mandatory rules that have to be respected. So to change them, you have to change the legislation. Sometimes the rules may include a default rule, so it is possible to deviate from that rule, but that places on the party wishing to deviate from the rule the burden of proof. And there are cases where a specific assessment, so an individual assessment, is required from the specific institution, in which case that grants a little bit more flexibility. Since I cannot go through each and every one of these examples, just to give you an example of the first, capital requirements, for example, are mandatory rules. So you would have to change the specific legislation in order to change them. Whereas there are others where there is a default rule. So there is a set of criteria, but a set of criteria where the burden of proof would be high for the institution trying to incorporate these or use these requirements in order to implement climate considerations. For instance, in the case of the countercyclical buffer, the institution would have to prove that climate risks are cyclical. As an example of default rules, for instance, you could consider that risk weights for the standardized approach are normally based on specific risk buckets that are often referring to external credit risk ratings. But at the same time, there is a requirement to exercise due diligence by the bank. So in that case, a supervisor could hypothetically prove that a bank has not properly exercised due diligence and that certain exposures belong in a higher risk bucket, just to give an example of how these default rules and burden of proof could work. And finally, as an example of specific assessments, That is the case of the SREP, or it is the case of the supervisory capital requirements or the stressed capital buffers, whereby the supervisor are expected to exercise their own powers using discretion, but also a specific methodology to assess risk drivers and risk controls, and to deploy stress tests in order to determine the specific capital requirements institution by institution using a forward-looking methodology. So as you can imagine, those cases where a specific assessment has to be undertaken impose a lower burden of proof to the extent that you can incorporate climate-related risks into your methodology, because there is no default rule that is against incorporating these risks. So in those cases where there is a default rule, you would have to prove that that default rule is inadequate because it does not sufficiently incorporate climate-related risks. And finally, the last question is, how would courts consider this type of assessment? So here we have, I'm offering a bit of a comparative analysis between Europe and the United States. So when it comes to Europe, there are some encouraging factors for legislators, regulators, and supervisors, because the competencies like the internal market under which legislation would be approved are broadly interpreted. The precautionary approach is generally accepted. The integration principle, so the duty to integrate environmental considerations into all the policies, is widely accepted. And certain potential constraints, like a doctrine of delegation to agencies, for instance, applies only to agencies, but it does not apply to the Commission when it approves level 2 legislation, or to the ECB, which is also a treaty institution. Finally, for regulatory and supervisory acts, generally the courts, when it comes to complex economic assessments, they only review for manifest error, which is a relatively lenient standard of review, and they assess whether the methodology provides for a plausible scenario, not a probable one. However, authorities must also be careful, because in certain cases, courts are known for making a relatively intrusive, or at least very thorough review of the factual accuracy, reliability, and consistency of the evidence. They also review the proportionality of the assessment, and sometimes they go a little bit far in certain decisions when scrutinizing the actions of supervisory authorities. So for those of us who deal with these matters, the livret cases are relatively well known. And there's also the unknown, the incognita, is the national courts, which might consider that an exercise of powers incorporating climate risks into prudential regulation and supervision could be something contrary to their own constitutional principles. Now, in the United States, there are also some encouraging factors. There is generally deference to agency expertise. Here we would talk about the Fed or the OCC, which if they were the ones exercising this discretion through expertise. There is a process-based deference. So the standard of review is the so-called arbitrary and capricious, which tends to look at the methodology employed by the specific agency. And there is also, in practice, a relatively special deference that is granted to decisions on monetary policy and financial regulation, at least if we look at the historical record. However, again, there are some cautionary tales. Last year, for instance, the Chevron doctrine of deference, meaning that protected the delegation of rulemaking powers by interpreting a certain legal act by agencies. This rule was derogated. There is some case law that links arbitrary and capricious standards to whether a cost-benefit analysis has been done or not, which can be tricky in the case of uncertainty. And there are some wild cards, so some doctrines that could come and limit what the authorities can order. So that is a doctrine of compelled speech that was raised against the regulations, against the acts by the SEC, which is now suspended on climate disclosures, and also to the California Environmental or Climate Disclosures Act. There is also the non-delegation doctrine, which has been dormant for a long time, but could create difficulties for the exercise of the powers by the Fed to incorporate climate-related risk into capital requirements. So finally, if we look at the strictly institutional perspective or legal perspective, one looks at legal act, burden of proof, on standard of review, and can more or less classify whether action on these different fronts, of these different measures of capital, could be likelier or less likely, depending on how challenging it could be for the specific authority to rely on this specific act. So since this finishes my presentation, and I hope that it was sufficiently synthetic and complementary, and happy to have the discussion.
Thanks a lot, David. Indeed, it was very complimentary. I think that's whether supervisors can implement and whether they will be challenged in court is also something that supervisors have in mind when they design such regulation. I just want to remind the audience that you can ask a question in the Q&A section that I will relay to both presenters. In the meantime, I have some questions. I apologize, I have a bit of a bias because I'm working on macroprudential policy in general, so I'm interested a bit more in the macroprudential part of what you presented, both. Maybe a question for you, Kevin, first. I mean, the loss distribution function that you've presented, does this reasoning also apply for macroeconomic for macroprudential policy? So when we think we have a lot of central banks that have emphasized that climate risk can potentially be systemic risk, and usually when you say systemic risk to macroprudential supervisors, the answer is that they should be a macroprudential policy addressing systemic risk. Those capital frameworks that we have now developed for other risks is applicable in your framework with climate risk, and under which condition for
Yeah, absolutely. I completely agree. But before I get to the macroprudential question, just let me thank David for his comments. I agreed with everything you said and the very practical implications of implementing changes to the regulatory capital regime and the level of conviction and certainty that policymakers would need to have is an important real world consideration. So thanks for your remarks. Pierre, on your question, absolutely. I think the logic translates pretty directly. You just have a even more complex question about how the distribution of losses might shift. You have different types of amplifiers and feedback loops that might make the shocks more difficult to model over time. And then you have a different set of policy objectives that a macroprudential supervisor would put weight on. I think the paper that you've recently done with Paul Hebert does a nice job of laying out that macroprudential perspective. And the example that you focus on, this question around compound risks, would be exactly that type of dynamic that would cause the shape of the distribution to change in a way that is not obvious or not clearly estimatable from historical evidence. So those are the types of empirical questions. And that goes back to David's point about how would you know how that distribution of losses shifts in a way that would give you the confidence to take a policy action in an ex ante sense.
If I may add to this, because I think it's right on point. If you look at, for example, the latest amendment of the CRD by the banking package in the European Union, now Article 133 says that you can include climate-related risks as part of macroprudential risks, or as part of the systemic risk buffer, the general systemic risk buffer. So in principle, that could allow for a specific assessment. So the most discretionary one. What is the catch, and why is it not as flexible as something that you assess via the SREP or the SCR? It says that risks not captured by the Pillar 1, Pillar 2, or the GC buffer. So the authority would have the burden of proving that those risks have not been captured by the other measures. So, and in that sense, it would need a higher degree of confidence than when, for example, implementing Pillar 2. Measures, just to give you an idea of how they could proceed. So it would be more logical for supervisors to start with Pillar 2 and then to move on to macroprudential measures like the one you suggested.
So I think this raises a question whether climate risk actually generates systemic risk. If Pillar 1 and 2 and SREPs, that's more institution-based level, and it's for the losses for each institution. Is there a layer of systemic risk that is added with climate risk? And that also, what you said also made me ask the question whether the current systemic or risk buffers that we have in the current macroprudential framework, can they be used for climate risk, or do we need to have like another buffer for climate risk? I think that relates also to the objectives of whether climate risk relates to the objective of other macro tools. Do you have a view on that, Kevin?
I think you would want to keep things as simple as possible, and introducing new buffers for every potential emerging risk seems very complicated to me. It seems a more straightforward approach to think about, say, the countercyclical buffer as being there to absorb system-wide shocks when they occur, regardless of the source. And then it gets to an empirical question, a calibration question. How do you estimate whether that vulnerability has increased because of climate change or any other risk driver? And that's the challenge. That's the practical challenge.
Oh, you want to add something, David?
I think that one of the challenges with Basel is that it's an extremely analytical framework, and by that I mean that it takes potentially very broad sources of risks, and it tries to put them in pieces, put them in buckets, and classify them. And that is a challenge for climate risk. So you could say that the overall methodology doesn't entirely suit very well. So adding categories would only exacerbate this problem. So that also goes to the point that Kevin raised. When it comes to this, I think that the general systemic risk buffer could capture this type of risk. And there are factors that I mean, I can think of other aspects that could be changed before changing or adding another systemic risk buffer, I think.
I mean, those answers also relate to the way we can calibrate and estimate such risk. And I think we all agree that with climate risk, we are with different animals in terms of risk, something that cannot be yet measured. I mean, it can be estimated, but and as you said, David, a lot of the current framework rely on a lot of on past data, on very analytical thing. If now facing climate risk, I think it's a bit unfair to ask supervisors for the burden of proof to be in a sense a bit let's say provocative. So do you think like in the law there is one way to take that into account and say, you know, here we cannot apply the burden of proof that we have applied in the past or that the burden of the proof should rather be on the side of the financial institution that don't want to have capital. And similarly, Kevin, maybe you can tell us this problem of difficulties to estimate and lack of past observation. How has it been treated and solved at BCBS? What are the recommendations for banks to treat such risk? Because they also have an interest to do the right choice.
Should I go first? Okay. Yeah. So on the issue of the burden of proof, two considerations. I've seen a discussion over the penalizing factor, both as a disincentive, but at the same time as a way to reverse this burden of proof. So to some, it is a way to disincentivize brown assets. To others, it's a way to acknowledge that when it comes to climate risk, which is mired in deep uncertainty, then perhaps you should consider that this could be something that is imposed across the board, and those entities that prove that they are doing enough to protect themselves against climate risk. And I don't mean only transition risk. I also mean physical risk, because that's probably where the initial bigger impacts may be. Then they could reduce this. So I don't know whether this could fly or not, but it's a second possibility to argue in favor of a brown factor. I have not had the time to consider whether this is sound or not. In terms of the burden of proof, like I said, when it comes to scenarios with deep uncertainty, the courts tend to apply a standard of review of plausibility. So that applies, for instance, for a scenario analysis, stress tests, and so on. So currently, I think that the difficulty is that most supervisors have not used climate stress tests in practice as a way to increase capital requirements or Pillar 2 requirements. But they could potentially do so. The standard of review that the courts would apply would be plausibility in principle, not just burden of probability. So there is a way in which the legal system acknowledges how, be more lenient on the burden of proof.
Yeah. I think another issue that is related to this, and David mentioned this in his remarks, was around this precautionary approach, which gets a little bit at what is the risk appetite of the official sector. And in a world of deep uncertainty, is it better to do too much or do too little? And what type of error are you will you have less regret over time? And in some ways, this depends on both the probability distribution of shocks, but also how does that translate into economic or financial outcomes should that shock realize. So that's just another level of complexity. There are cases, certainly in the US historically, where policy or regulatory supervisory actions were taken on forward-looking estimates. I think there's a general consensus that, it's better to have supervision and regulation be forward-looking than backward-looking. But that does introduce all of these legal challenges that David mentioned.
Two questions from the audience. One for Maria Nieto about whether there is a historical experience in the US, but I guess also in Europe, if you know, David, about having a macroprudential capital buffer for risks that for which actually no microprudential buffer were requested. like climate risk only at the macro level, not at the micro level. And another question about other tools from Pascal Ville about whether what you said about capital could also apply, for example, to liquidity risk and having liquidity buffer. Does that make sense for in the case of climate? I would extend that to also macroprudential buffer for other part of the financial system, like insurance or non-bank financial institution. Would that make sense to, in the case of climate, to look at that?
Yeah. So in answer to the first question, not that I'm aware of, but there might be examples. And then to Pascal's question, my reading of the literature is that there has been much more work done on the potential impact on financial losses through credit risk and market risk rather than liquidity risk. But I think the same questions would apply. How would you calibrate the change in potential liquidity shocks, whether they're withdrawals or changes in how firms access liquidity? And then which of the different liquidity tools would be most appropriate? There are a whole list of risks that, say, the Basel Committee had talked about: credit risk, market risk, operational risk, which we haven't really spoken about, was on that list. And one important framing point, I think, is sometimes we use the shorthand of climate risk, but from a bank's perspective, climate's a risk driver. It is something that happens that impacts a traditional risk, like a credit risk, a market risk, or an operational risk. And understanding that linkage and how it can change over time, how that dynamic linkage can change over time, is really the question.
I think that the points were really well made, so very little to what I'm not aware of capital buffers for risk for which no macroprudential buffers were required. In terms of liquidity, I think that the difficulty is that normally with liquidity you tend to model these based on historical experience. So we would need some kind of example of how liquidity would behave in a situation where there is a climate-related impact. I'm not sure how this would play out, and perhaps it is this difficulty that has perhaps dissuaded the literature from modeling this. But that's not the only thing. And touching on a point that Kevin raised, I think that one of the things where the framework is clearly not very well suited is operational risk. Operational risk is clearly based on past losses. So there is an estimate of the loss component. You compare the loss component with a business indicator, and depending on whether it is higher or lower, then you will have more capital for operational risks. But that is an entirely backwards looking approach, not forward looking. And there are new operational risks that can arise related to climate, physical ones, but also transition ones and litigation ones. So there's very little in terms of accounting for litigation risk.
We quickly approaching the hour. I would have liked last one question on the different view that you presented in the beginning, Kevin, about using prudential regulation to, let's say, absorb the risks, and using prudential regulation to support the transition and drive. And given that central banks have emphasized that basically a transition is the best way for financial stability. If we end up in a 5-degree world, you probably have a much worse situation for financial stability. So in a sense, for financial stability purpose, supervisors have an interest in seeing the transition happening and maybe supporting it. So would such view not reconcile a bit the risk and the supportive view from a financial stability perspective in the long term?
Yeah, so this is a really important question, and one that there's a lot of discussion around. If I were to take a very narrow microprudential perspective and try to work that through from a double materiality perspective, which I think is what you're getting at. And generally what that means is what I talked about in the traditional approach was climate change happens. That's an exogenous shock from the bank's perspective. But the bank's activities could contribute to climate change. Financing fossil fuels or financing renewable energies could change that dynamic over time in a way that ultimately feeds back and affects the risk of the bank itself. From a purely conceptual, purely microprudential perspective, my intuition is that that feedback effect is likely to be small, that any one bank's actions are unlikely to have an impact on itself in a way that would be a material risk to manage. If you amplify that to the system as a whole, from a macroprudential perspective, the case gets stronger because you're thinking about the feedback effects on multiple participants in the financial system. You still have the same question about burden of proof and materiality and how do you estimate it, but directionally, conceptually, I think that is right. But again, my intuition is that it would be hard to make that case from a microprudential perspective.
If I may add my 2 cents, I agree with this. I think that when it comes to the transition perspective, it's hard to make unless it is a macro measure. But if you start from the perspective of financing adaptation measures, for example, there might be something there of joining the perspective of transitioning on one side and mitigating risk on the other side, meaning that banks that fund adaptation measures by different entities are less likely to suffer the impact of bigger defaults or chronic decreases in profitability. So the type of things that may impact your credit risk. So there may be something there.
So for making this distinction with adaptation measure, I think that's something that I've never heard and makes sense first. We have reached the hour. I want to thank you both for this very exciting discussion and both your presentation. Just before we leave, I want just to remember the audience that there is a next webinar on November 3rd, and the speaker will be Alan Stiroh from Stanford University. And he will present his paper, The Global Effects of Carbon Border Adjustment Mechanism. After that, thanks again for both your presentation, and I hope to have an opportunity to discuss that again with you in the future.
Thank you, and thanks for having me. This was a lot of fun.
Thank you very much.
Thank you.